Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. The inflation hawks are out. The latest US CPI data for June showed inflation at a whopping 5.4%. And Fed Chair Jay Powell was grilled in DC by Congress on inflation. But rates markets don't seem to be worried, and neither are we. Indeed, we published two pieces this week explaining why. One looks at the CPI data in more detail, and another looks at how US fiscal policy may turn out to be negative for US growth. We also have pieces on why society is not ready to fight climate change, how long-run equity performance may not be as strong as you think, and an analytical piece on why England lost the Euro 2020 finals. To find out the full details and access all of these pieces, you can become a member of Macro Hive at macrohive.com. This also gives you access to our archive of research notes and to our member Slack room, where the Macro Hive team and members discuss markets all hours of the day. And it's refreshingly different from Twitter. When you sign up to Macro Hive, the first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. Once again, sign up at macrohive.com. And if you're interested in our more high-octane research product for professional and institutional investors, drop me an email at bilal@macrohive.com. Now, on to this episode's guest, Roshun Patel. Roshun is Vice President of Lending at Genesis, the world's largest digital asset lender. Roshun has a background in computer science and has been immersed in the crypto world for most of his career. So, on to our conversation. So welcome, Roshun. It's excellent to have you on our podcast show.
Thank you so much, Bilal. It's a pleasure to be here.
So Roshun, I thought, as I do with all guests, I often like to ask people about their backgrounds. So what did you study at university, and why did you end up in the crypto space, and where are you now?
Yeah, for sure. I guess we'll start with the university part of the starting point of the background, because you could go pretty far back. But I went to Northwestern University, kind of in Evanston, Illinois. I graduated in 2017, so not super long ago. I studied a program called Mathematical Methods in the Social Sciences, which is like a sort of an applied mathematics major, but a little less theoretic, more like sort of pragmatic, and then computer science in sort of the engineering school. So the math program is like sort of an adjunct major. You have to do it with something else. Most people did economics. I decided to do computer science because, I don't know, I just thought it was interesting. And that department kind of grew up quite a bit between my freshman year and senior year. So it was awesome to be able to see kind of the growth there in that department. And then kind of while I was Northwestern, so this is funny, I was a good student in many ways, but also I didn't get I was a great student in high school. I got great grades then. And in college, obviously it's a little bit more competitive. So I was I was a solid student. I wasn't the best, I wasn't top of the notch, getting straight A's in all my classes or anything like that. And as a result of that, a lot of the sort of more, I would say, traditional routes that people would take, whether that was consulting or investment banking, it was just a little bit more difficult for me to do that. Because I'm hey, look, I know my GPA is not as great as the other guys, but I'm taking really hard classes. They're oh no, sorry, it's below the cutoff. So I was okay. So I kind of had to go for something more maybe democratic in terms of getting in and also sort of performing. And that's kind of when between my sophomore and junior year at college, I started working. It was my first internship, really. And I worked at the sort of options exchange and the CBOE in Chicago, kind of on the floor, as well as at a market making firm upstairs that kind of had electronic traders and sort of floor traders. So I got exposure to both. And that was my first foray into kind of trading and markets in the most real sense. I've always been interested in the stock market, post-financial crisis and whatnot. But that was kind of a monumental sort of time because I think it definitely shaped my career in many ways. At the time, the Greek referendum was going on. There was concerns about Chinese GDP growth and all sorts of sort of interesting macro flows there and that's also when I first discovered Bitcoin. Then the following summer, I kind of worked in FX, sort of algorithmic trading at a place called Gelber Group in Chicago, which is a sort of large prop trading firm, or I guess medium-sized. But in any case, during that summer, the Ethereum DAO fork, or the Ethereum, DAO hack happened with the ETC. So we got a 50% discount into ETH there. And that's when I first kind of started researching ETH. And it was also the same summer as Brexit, leading into sort of Trump getting elected. So all those sorts of things like really shaped like a lot of and I was like, okay, this is way too exciting. Trading is the way to go. Worked then kind of after that in trading at Gelber for a few months after graduating. And at the same time, I was super interested in the crypto market because it was kind of getting really, heated. And I was sort of just long, like I never really traded much. I just like kind of bought it. And it was just like a matter of accumulating and buying things. But I started cutting my teeth on the side outside of work in some arb strategies, mainly like trading crypto versus crypto on American versus offshore exchanges. And it's funny because like ultimately, like I ended up probably flat, if not a little bit down, which I'll get into. It's just kind of how I ended up here. But at Genesis, effectively what happened was, that became a really sort of exciting thing where I left my old job just to kind of trade arb in crypto. Met two of my friends who are much better programmers than me kind of met up with me after work, and we sort of coded all these bots to do these arbs. And then fast forward, and that was like sort of in the fall of 2017. This was like the year I graduated. And then fast forward to March of 2018, market really cooled off, as well as I think some really sophisticated players got involved in the space. So effectively what that meant for me is there was not like a retail bid driving these spreads super wide. And on top of that, like the sophistication of market participants, they were just a lot faster and better at me than coding ARB. So that trade just sort of dried up, went out to Asia on a solo journey and kind of went to like Singapore, Hong Kong, Macau, Thailand, just like kind of was out there figuring out what to do next. And I was looking at my sort of P&L and I was like, man, if I could have just borrowed a lot of these assets, I would have done a lot better at this strategy, like through it. Because as I scaled up, the prices went up and I took a lot of hit on Delta. And then I Googled like, how do I borrow Litecoin? I remember while I was in Singapore, and Genesis came up. And like, yeah, from there, the rest is kind of history. Last 3 years, I applied for that job as an analyst because I was like, maybe I'll work for a company that's doing something that I know is going to probably be a thing in the future. Because back then, no one was really lending out any sort of crypto spot. There was very few derivatives exchanges. And yeah, sorry for the sort of long background there. I started from the beginning kind of, but.
Yeah, no, that's very useful. Yeah. I mean, just on the lending side, I mean, this is something that's quite intriguing because when I think of lending and yield, I think of the interest rate curve in bond markets. And you kind of think, okay, there's a bond, there's a coupon, you earn interest, and everything is kind of priced off that, But then in the crypto space, the asset doesn't have a natural yield per se. So, I mean, how does one think about lending, borrowing, and interest rates in the sort of the digital asset space?
Yeah, look, like over time too, this has evolved quite a bit. And there's also different assets now that have all sorts of very different flavors that like have different reasons for borrowing them. But for the sake of starting the conversation here, just looking at Bitcoin to begin with and how you think about what could drive an interest rate on Bitcoin. So in 2018, when we first started lending out this crypto, and like Genesis has been around for some time, trading spot, and then part of a larger venture capital firm called DCG. But generally, specifically on the lending side, that started in 2018. And it was really came out of a reason that was based on the CME futures, really, which is, you had the CME futures that were just launched in December of 2017. And after the market froth happened in 17, 18, starting in January, like the first expiry was January. But spot was so volatile and moving up so much that future was trading very different from spot and often very below spot. And same thing with March, June, September, and December expiries for all of 2018 were just at a pretty steep discount to spot, like this very backwardated market. So just any sort of commodities trader mindset would tell you there that like, yes, there has to be an interest rate on Bitcoin spot because you should sell it and buy the future and wait for it to converge at expiry. So that's like the most basic first naive level.
So I guess that's equivalent to what we would call the roll yield, or, the way people trade commodity futures. We have backwardation, curves inverted. So you buy the long dated futures and you wait for it to roll up and then you earn the kind of the roll yield.
Yeah, exactly. And the difference with crypto markets, I think in many ways is that with a commodity futures yield, like it sort of linearly moves that way to expiry. Like the market here is so volatile on spot, and the desire for leverage coming from retail could go up and down so much that like the curve actually could like zigzag into expiry, like go premium, contango. So there's a lot of money to be made in terms of having cash and Bitcoin available to borrow. But, Bitcoin specifically on when it's cheap to rich sort of move. And that's kind of the move that you saw in 18. So that's like the first reason why there would be an interest rate on spot. There's many more reasons too. There's like people that have future cash flows in Bitcoin and they want to hedge. There's businesses that only take collateral in Bitcoin, and trading firms want to collateralize those exchanges with Bitcoin. There are remittance use cases. There's, ATMs. There's all sorts of other ones, but the futures use case, especially from a trading angle and from like a macro, I'm sure for the people listening to this, that one I think makes a lot of sense. And it could be anything, right? It doesn't even matter, like Bitcoin, whatever. So,
and in terms of other types, actually we can come back to some of the other markets that have sort of lending characteristics. But you mentioned the 2018 correction. Now, in 2021, this year, we've had a large correction as well in May, big decline. And then since then, Bitcoin's kind of gone sideways, you could say, slight sort of downward trend. And there's been a lot of speculation around why that decline happened. There's been talk about Chinese regulation, miners in China coming offline. There's been talk about sort of large flows and things like that. I mean, do you have a sense of what caused the correction?
I mean, so I think, the market moved up quite heavily, Bitcoin, ETH into sort of January, February, March. And one sort of statistic I like to look at is like the percentage of addresses that are out there on chain that are in profit. So you can kind of do that now. Like there's some good sites that also do this for you, but they kind of show you like based on when inflows came into said addresses, like are they in the money or not? At all-time highs, obviously that just innately has to be 100% of all addresses are in profit, and the degree of which they profit, like when that notional, I think exceeds like quite a bit of number for a lot of sort of people out there in the market, retail and high net worths and institutions included, it really tests your unwavering, where it's like, okay, you believe in this long-term, this is like a real thing, the fundamental thesis hasn't changed, but also look, like this is where you bought it, this is where it's at, you're up this much notionally. And then you factor in a little tinge of macro concern, right? Like with rising interest rates and inflation and the economy reopening and just a little bit more uncertainty on that angle, which is like the first flavor of like sort of worry there that could cause traders concern. Then you factor in the fact that we don't like to say it, but like, there are like sort of big personalities in the space. Like take, for example, like your Musk types that like bring to light certain like ESG concerns, and whether they're true or not, that's not the problem for when you're thinking about it from a trading perspective. It's just the top line narrative and headline that's going to matter. So you have that. And then China too, again, it's like when you read into like what that actually means in terms of the mining and the hash rate sort of declining and mining moving out of China, it's not necessarily, in fact, I don't think it's bad at all. I think it's very good for like promoting a globally distributed network, but that's not the first level instinct. And like with the way that the market has been conditioned to trade, it's like you shoot from the hip, right? It's like when these things come out, it's not like, oh, if you've only lost money under actually understanding like a headline and like trying to be smart and thinking that the market's going to understand the headline. A good example of this, for example, is back in the 2020 sort of run up, like in prices. This was in the summer. There was a tweet from like a very well followed account that said, hey, Satoshi Nakamoto's coins are on the move, right? Bitcoin was trading at around 10K at this point. Very quickly, like good sort of analysis on Bitcoin that you could have, like smart traders or people that are very in tune with the market have access to, quickly identified that was not the case. That being said, 20 minutes after that tweet happened, you just saw a cascading sell-off to like, it's like a 7-8% move within minutes. So what does that condition the market to tell like sort of algorithms that are doing sentiment or even just traders that are good at what they do? It's like, forget what it actually means, like really shoot from the hip on headlines. And that's like kind of maybe over time that dilutes. So I think going back to the original question about this sell-off, I think you saw a wave of things that are at surface level could be interpreted as bad. And it just caused a lot of hip firing there. And I think like that's, that's natural for all markets, and like it'll evolve over time into how effective that sort of strategy behaves, because it dilutes over time. Then the algos come in, they start reading the sentiment, they start reading the tweets, they do it first, then it becomes like a sort of battle there. So I would say those are the main reasons you saw for the sell-off. Like, it's just what the market's been conditioned to do, and profit taking. And it's like 50% drawdown from 60K to 30K. For me, it's like, that's almost wild to say, because it's like, oh my gosh, we're at 30K. Like we were at 6K to 3K like a couple of years ago. So it's like we added 0 to the drawdown.
Yeah. I mean, I think one of the challenge with Bitcoin is the volatility is so large that if you adjust the drawdowns for the volatility, it actually doesn't look so bad. It's just that we're not accustomed to assets which shows high volatility. Whereas if you look at, say, equities, volatility is much lower. So then the moves seem more contained. But you're right. I mean, if you were trading at 2,000 a number of years ago and now you're 60,000 or 30,000, that's a huge increase already.
Exactly. I think the difference too between this sell-off and a lot of previous ones you saw is probably like just the more idiosyncratic nature of like asset prices. Like sometimes you saw like sort of like little like bright spots in these sell-offs where like some things were just bid, other things were trading very differently. Before it was like Bitcoin goes and everything cascades like more so, like everything had at least a 1 beta, some even like, but now that's changed a bit. I think that's good. That is a sign of a maturing asset class, right? Some people will tell you Bitcoin's the only thing that matters out here, but like the market, and whether you believe that or not to be true, like I'm just saying that like empirically the market's saying like, other things and sell-offs or even moves up in Bitcoin or moves down. So like there's a lot more differences going around with assets and relative to how they performed January to now and whatnot. So like there's more difference too. So it's like just looking at Bitcoin, it's like, you could say it's super volatile, but there's also other things out there that are behaving quite differently when Bitcoin sells off or rallies for that matter.
Yeah. And when you say other assets, I mean, what are some of the main ones you'd sort of highlight?
So yeah, if you're looking at, like, you have to look at Ethereum too. Like there's no question that's like obviously the number 2, then like, I think you want to look at sort of like Ethereum sort of competitors and kind of how they behave, like sort of like your Solanas and things like that. And then like, even ones that are like a little bit more like retail favorites, like even Dogecoin is an interesting one to look at, or like some of the like, other coins out there that are just like a little bit different or do different things. Yeah, I think, it's important to kind of look at when Bitcoin sells off, how all those relatively move. And there could be like interesting sort of finds there. And you could also plot like coin versus Bitcoin to see like rel-val moves in an easier way rather than plotting them all against dollars. So if you throw up some of those charts relative to Bitcoin, like, you'll see some interesting trends that you might not see on both the dollar charts.
Yeah. And in terms of the geography of the people who invest in these markets, is there a big kind of Asia, US distinction, in terms of who drives the market?
Yeah, I mean, I think like the risk-taking tendencies in Asia and the US can change like based on sort of regime. And sometimes Asia and the US are in tandem with what they're doing. Sometimes they're actually completely opposite and competing. And like that shifts sort of, like it shifts more on a whim. Like it's kind of like difficult to know when or how. But I would say broadly speaking, like, the US market and the Western market tends to be more spot focused and like in the sort of your major assets, like the top 10, like Bitcoin and Ethereum. Whereas like the Asian market, I think moves on and to the next things like much faster and is like more interested in like newer things, shinier things, and uses a lot more leverage than maybe the American market. But then also like it could have like sort of, it could be also more tepid when the American market is more, or the Western market is more sort of aggressive. Like for example, in May of last year or May, June, kind of the run up really off the lows from 3K, 4K after the March sell off, like you saw basically like a very strong spot bid on like the Western exchanges, but like a spot offer and a derivatives offer on the Asian exchanges. So that's like, one side of the market is selling and hedging and buying puts and selling calls and giving up upside. And the other market is just kind of piling cash into spot. So and then, it's like which flow ultimately wins and comes to light at the end. It's just a matter of, I think, like kind of which side capitulates into like being like, okay, I'm all long again, or okay, now like the market sold off quite a bit, like, so it's interesting, I think, but it's hard to know. Like at the end of the day, it's a global market.
Yeah. And in terms of, you one often hears of the hodlers and such, that a large part of the market just doesn't sell Bitcoin. I mean, is that something that you focus on at all or not? Or I guess that's then associated with the lending side, I suppose. But how important is that kind of feature of the market?
Yeah, I guess to speak to your question in terms of first, like how important are the hodlers to the market? Like, I think they are very important, and there are more and more of them in terms of like, there's always an accumulation bid down there. There's always put sellers that are forced to buy, or, just collecting the theta and rolling their premiums into spot. A lot of people that make money trading derivatives tend to take their gains not into cash, but into spot. It's almost like an option on top of your gains in a way, right? So like, I think, and if you assume like the more sort of investor type, long-term focused traders are winning in derivatives markets, which are zero sum, that means there's going to be naturally more hodling as a result of profit being rolled into spot there and sort of transferring over to people that are responsible at holding that spot instead of selling it on a whim. And I think they are a huge component of the lending market because they're very comfortable lending Bitcoin and other assets for yield, letting people kind of borrow for whatever reasons, but confident in the long term where they're collecting in-kind interest. And if the prices go up, they're doing pretty well on a realized yield perspective relative to dollars. Like people that were lending us Bitcoin and ETH as early as like sort of March of 2018 and kind of kept that going to like now and collected in-kind interest every month along the way at previously pretty high rates in 18, 19 and now lower, but still like on average, very solid rate. Yeah. It's been a great trade for them.
And when you say in-kind interest, what does that mean?
In-kind interest means you lend out Bitcoin and you get Bitcoin in interest, or Ethereum and you get Ethereum in interest.
Okay. And how does the lending rates get determined there? So say, for example, I'm somebody who's, I've got X amount of Bitcoin, I'm holding it long-term hodler, and I want to lend it out. Like, how does that market get determined?
Yeah, so it's a supply and demand based market in terms of how much supply is being willing to lend to the market, and then kind of what demand is out there and what rates are out there, and then kind of what Genesis can reasonably sort of collect as a spread, which comes down over time as more competitors enter the market. If you're talking purely quantitatively, like let's just using the demand example of the content of the backwardation, like you can just say mathematically what the rate is you should borrow on it based on that. Of course, though, there are more esoteric reasons that have popped up, like with, on chain, or like people that like can like trade the curve's volatility more so than just like the linear assumption of where it goes. So then, the rates could ebb and flow based off of that. And then also like if more supply just enters, like, if some corporate treasury just like buys like, yards and yards of Bitcoin and then just like is willing to like lend it out, or post it as collateral and borrow cash, like that could impact the rates on cash and Bitcoin accordingly, because now there's all this collateral in the system and there's also this big drawdown of cash out of the system. So, those kinds of demands and flows impact the rates quite a bit. And then on the cash side too, it's the same thing, right? It's like how rich are the forwards and the synthetics relative to spot? How strong is the demand for leverage in this space? Like how much do people really want to get into spot without putting up any sort of, without tying up their own cash and getting effectively like a leveraged product. So all those things kind of impact the rates. I think over time, what we've seen is into this market, there's just been more and more supply willing to enter. So there's like a downward drift on Bitcoin, ETH, and cash rates, just because more as the market exists for longer, as people are more comfortable with it, as DeFi and things like that pick up, where there's on-chain borrowing and lending, like generally the concept of debt is becoming more normalized in the market. So as a result, there's just more supply notionally.
Yeah, understood. And when you say on-chain, I mean, can you just elaborate what that means, just for kind of more for generalist audience?
Yeah, so on-chain is like when we talk about Genesis, I mean, like, yes, the transactions we're doing to and from customers are on-chain, but where does like the loan actually live? Like it lives in our database and our systems. We say like, we have an asset and a liability, and it's on Genesis's sort of servers and systems. Like, it's centralized and sort of private. On-chain is more just like, if someone did that, but if you're doing that with like a sort of smart contract that determines exactly your interest rate, your borrow rate, your collateralization level, your liquidation level, and sort of quantifies every aspect of the loan, and it just lives in a smart contract on, for the sake of this example, we could use Ethereum, and it's sort of visible for all and very like sort of democratic not democratic, just easy to access, let's just say, where it's like, there's not the stringent KYC or AML that Genesis would have. You kind of just plug in and play. There's modularity and all sorts of interesting things. So it's a completely different product, I would say.
Yeah. And that, I guess that's part of the whole DeFi market, I suppose, the decentralized finance market. That's a central part of it all. And, within that market, there's, one hears a lot about yield farming. I mean, how do you have any views on that?
Yeah, I mean, like yield farming and kind of extracting yield on chain. There's a lot of interesting components of it. There's like ways to do it that I think like there's examples that make a lot of sense for like why there could be yield farmed on chain. And there are also ones that are like, hey, like, this is like someone just basically copied another protocol and created their own token and it's just disseminating it at some rate. And the price of the token is this. And, like, they're just kind of like, eventually this is going to die. Like maybe people will make some money at the start, but there's not really much interesting or new about it. It's just sort of like the same old playbook over and over again. So there's two different, I think, components of it. And we can get into talking about like good examples of the first or examples of the second if you want to, but I would say like yield farming, it has good components of it. Like there's things out in there that make sense and we can talk about them, but there's also, you have to be wary because if you loop it all together and you see the wrong thing first, you're just going to be like, this is dumb. So like, don't like, get jaded if you see the wrong thing kind of first. Yeah. And the second one could be risky.
Well, just so I guess for balance then, I suppose, maybe you could talk about an example of a good case of yield farming, because one often just reads about the horror stories, so it'd be good to.
Let's so maybe talk about one or two good cases. Okay. So one good use case of yield farming is, let's say, on-chain insurance contracts, right? So let's say you own like a sort of whatever, like a sports team or something, and like in an area that's not really prone to like bad weather at all. But if there is bad weather, you could get catastrophically screwed on like ticket sales and repairs for your stadium. So you're going to buy this sort of contract. You're going to basically buy insurance on that by saying that like, look, like I'm going to pay X amount for insurance, and I'm going to get paid Y amount if all these parameters hit, which is rainfall, snow, whatever. And like, there's all these sort of things that hit. On the other side, you have people that are sort of speculators that are like, maybe good at pricing weather models or whatnot. And they say, hey, I think the probability of this sort of happening is whatever. And like, I'm willing to offer this tranche of that at this interest rate. And if it all triggers, I'm going to lose my principal, but otherwise I'm going to get yield from that first person that's like willing to buy this contract. Normally, when you think about how this is done, it involves calling like 5 different people, going through a bank, going through a brokerage firm, whatever. With a smart contract, you can parameterize all this. And assuming you have the Oracle data flowing in for all these sort of prices and feeds, there's a direct peer-to-peer payment and consistent flow of interest rate that the person that purchased the contract is paying out to the people that are staking into the contract and getting out. That is an example of yield farming, where you're basically taking a little bit of risk, but you're getting a yield out of it, and you know exactly what's going on. And if it triggers, it triggers. Another good example is just a smart contract on chain, which does a put selling strategy or a call overwriting strategy. So you can put Bitcoin and Ethereum into a smart contract, and it'll start selling calls for you, and it'll pass back that yield, and it'll give up the upside on your principal automatically. Similarly, you can put USDC into the vault, and it'll give you yield, but it's going to make you a forced delta holder at a certain strike. So those are examples of yield farming where I think that just makes sense. Like both of those cases, like there's a fundamental reason for the yield. There's not like any sort of nefarious copying and pasting or like, whatever it might be, like new token that's like a copy of another, but they make sense. And those use cases I think are going to explode in value and use over time.
Yeah. I mean, one thing one hears about with such sort of transactions and transactions in general in the crypto space is the speed and the cost of transactions. So I guess in the Ethereum space, the gas rate and things like that. What's your view on that? I mean, is that something that inherently will be something that will just stop the growth, like a rapid growth of these sorts of markets?
No. Yeah. So in terms of the gas and Ethereum specifically, those prices have moved a lot, and there are iterations on it and improvements that make it lower and more expensive. I think all of it is born out of all the iteration in terms of what's happening in terms of gas price and fees is coming out of necessity, right? Like all these contracts, all these trades, all these decentralized exchanges are getting a lot of volume. And if there's moments in the market where people need to send a lot of assets at the same time, this gas effectively gets bid up in price because everyone really needs to do something at the same time. And that's always a function really of price moving, because since there's so much collateralized lending and borrowing going on chain, when price moves down drastically, people need to move collateral, whether that's out of DeFi and smart contracts into exchanges or brokerages, or vice versa. It doesn't matter. Or even brokerages transferring between each other completely off, any sort of smart contract or anything like that. There's just a need to transact that all spikes up at once. So it's like, the network is at totally fine until like everyone needs to use it, and then it's not fine, right? So those flares of upticks, it's going to take iterative improvements. And like Ethereum has made quite a bit with like Arbitrum and Optimism, and now with sort of staking in layer 2, like, it's going to get faster, it's going to get improved. And I think there's important distinctions, and you can get into the technicals of it, but like Ethereum has like a mempool where it's like, all the transactions that want to be confirmed and want to become real are sort of broadcast all at once. And the miners kind of pick up the ones that they get paid the most out of. And that sort of bids up the gas fees. There's interesting things out there called like miner extractable value, where like, people that want to get confirmed can pay a miner directly, and it avoids bidding up the gas because it's just a peer-to-peer transaction between the person that wants to pay and the miner. And there are sort of ways to signal that are improving. And then you also have completely different sort of structured chains like Solana, where it's a stateless machine, and effectively there is no mempool. and everything's kind of synced at once. And those are, different approaches to the same sort of challenge. And, I think both are going to make strides and improvements in the future. Even Solana got congested at a certain point when a lot of people were using it for some reason. I forget what it was. Maybe it was it wasn't necessarily price. It was more like some new pools or yield farms kind of launched at the same time. But in any case, like even a stateless sort of network could deal with congestion. But as long as the needs for transacting exist, like I have confidence in like sort of the ingenuity of programmers and developers across the space to keep improving and iterating on it. And I think, the gas prices and the fees, like it prices out a lot of smaller use cases, but over time, I think that'll become, less of an issue. It's just a matter. And right for now, it's like if you're trading large enough notionally, the percentages are still extremely low. So
yeah, I guess you see something similar in financial markets as well. There's like, pockets of illiquidity where suddenly liquidity dries up in the market and bid offer spreads widen a lot. So it's not something that's confined to the crypto world. It happens in every market.
Oh yeah. Yeah. Talk about bonds and whatnot. But yeah.
Yeah. And one thing I wanted to sort of discuss is just some of the microstructure aspects of the markets, the way exchanges talk to each other, and then the role of Tether, within the system, because there's been a lot of focus on Tether. So, perhaps you could sort of talk a bit about what Tether is and then its importance within the crypto world.
Yeah. So, I mean, like Tether is effectively, it was the first stablecoin that existed, and then a lot more kind of came up after Tether kind of started getting serious market share. And I think it was like the fall of 2018 when you first saw like the Tether competitors come out, and they all sort of cropped up instantly. And their sort of claim to relevance was, look, like Tether exists, but it's sort of a black box. Like there's not like, you don't actually necessarily know where the money is held or whatever, at least publicly, the market doesn't know. And the other stable coins were like, look, like we're going to onboard with like this very regulated bank. And here's a smart contract that's linked to our bank account. Anytime a dollar is deposited, it mints a token. Anytime a token is deposited, anytime a dollar is withdrawn, it destroys a token. Like one-to-one backed. And there's like very sort of reputable auditing firms just ensuring that number of dollars adds up to number of tokens, like super simple math. And those are sort of proliferated. And I think like that create redeems, and it allows you to create and redeem those really easily, like USDC or Paxos or GUSD and those other ones. Tether, it's a little more opaque in terms of the process, in terms of onboarding, in terms of getting all that done. And you could still create and redeem it, like, to be clear. It's just not as like, I guess, transparent to do it. And like and that lack of transparency, I think, causes a lot of speculation in terms of what's underneath there, how much of it is in dollars versus not in dollars, like invested or in illiquid things or liquid things that they would have to sell or things like that. So there's all these speculation. I don't know necessarily how true or false any of it is, but Tether does have this very strong network effect where like, there's always kind of like a bid in it. And I mean, like, you could speculate at what could cause the Tether peg to break, but it's all real speculation. Like, we could have a speculative conversation there, but I think it's also like, yeah, there's a lot of like, the fact that it's just untransparent makes people like, I think imaginations go like really down the chain.
But Tether's it's still quite heavily used to sort of transfer flows between different exchanges and different markets. It seems to be quite a central part of the system. Is that a fair thing to say?
Yeah, because the float in there is by far the largest of any of the stable coins, but also, and the question is like, well, how much of that is first mover advantage? Like, is the float so large because it came up so first, and is it used a lot because and I think a lot of it is, and there's in any space, of course, there's massive advantages in being the first mover advantage, but the Tether just being as big as it is now is like a testament to how like insanely valuable that first mover advantage was in just an on-chain digitally transactable dollar. And the first Tether sort of wasn't even on Ethereum. It was on this chain called Omni, which like had Bitcoin addresses and moved like much slower than Ethereum Tether or any like Solana Tether or anything like that now. Like, so it wasn't even that like fast or like, but it was so much faster than what existed there, like bank wires and whatnot. And like, for traders that wanted to get like crypto to crypto exchanges, but like not take like slippage in price risk moving back and forth, like Tether just solved this huge need. And like with the price run up you saw in Bitcoin and ETH and like the market cap run up, like it makes sense that Tether had to like follow suit a little bit because like there's just that much demand for just moving around stable value on chain. And that first mover advantage has proliferated for years. So they've gotten, I think a huge component of Tether's sort of like sort of volumes and size, and just the fact that it consistently has a bid and people are always willing to buy it. I think that's a massive component of it.
Okay, yeah. And in terms of like, some of your clients of Genesis and stuff, what's the makeup of your client base, and what types of things what's the sort of common day-to-day that they get engaged in?
Yeah, so currently the client base, at the core of it, like our sort of largest core clients are more like trading firms that have like a lot of delta neutral strategies going on that are native to crypto, but also do other things as well, or they're just like exclusively focused on crypto. They're like good, they're like very smart risk takers effectively, and they know how to manage, derivatives or spot positions or spot versus spot, and like have like good sort of trading desks. Like that's our core client. Then you have like sort of the hedge funds, which are more long and like have like core theses and core asset bases. And, those could be on the supply side to us. They could also be on the borrow side, posting these things as collateral to borrow cash, but not even to like lever up back into the same assets, but just to like, manage liquidity around a more illiquid position. And some of those guys tend to go like, long short as well, which I think the market has evolved on the long short side. Whereas like in 2018 and 19, like you had a lot more long short players than you have now, partially probably because of effects of like GME and AMC and moves and things like Ripple and whatnot. Like bad news hits and things go up. Like, it's like weird. So it's hard to have that sort of the beta models, I think, have gone all wonky in many ways. So people are just like, what, I'd rather just, pick where to be long rather than long short. So it's a little bit different. And yeah, like and then there's like sort of a more like down the curve esoteric client, like just like, you could have a remittance or an exchange or like a use case that's a little bit unique. And those like are very specific different ones, but those are very on the end of the spectrum.
There's obviously over the last year, there's been a lot of focus on some of the conventional institutional investors and asset managers, pension funds making allocations to crypto in some form, often Bitcoin. Is that something you think will continue?
Yeah, exactly. And I didn't loop those into the earlier buckets explicitly, but I would put those in the hedge fund category. And those hedge fund clients, or I say hedge fund, but you call it pension fund. They've evolved over time. Where before it's been like just like the crypto native ones, but now it's like you have like more that are tech or NASDAQ native or stock native or whatever they might do, and that are now creating adjunct businesses in crypto or like so that they're kind of getting into it, but it's not their main thing. So a lot more of those coming in. On more like, I guess your question was more specific to like pension funds and mutual funds type of things. Yeah, I think look, they have those firms have a lot of dollars. They want to get exposure. They want to diversify exposure, but I think also like the suite of products becomes more interesting to them than like just like buying spot, holding it in cold storage, right? Like if you can do call overwriting, or even like forget even buying spot, you just sell puts and like get yield and then be a forced buyer if you have to, or if you could lend it out or borrow cash against it. Like all those use cases make it easier, I think, for firms to do that. Because like mutual funds, like all do like this call overwriting strategy. It's like, well, you could do it in Bitcoin too. And I think there are a lot of firms out there like gunning for that kind of client, and including Genesis, but also others too that are very focused.
I mean, how large is the options market? I mean, can it handle a large like call overwriting programs and things like that?
Yeah, exactly. That's another good, because the options market right now is definitely notionally large. I mean, I don't have the numbers in front of me, but you're talking billions and billions of open interest and very, very, very big volumes. But you're right in the sense that like some of these guys like manage like what, like 100, 200, $300 billion, right? Like, there's like, I guess, some of the largest asset managers manage like 170. So like whatever, but aggregate, it's maybe a couple $100 billion. Like Ethereum's only worth 300 billion, like the underlying, and like Bitcoin's only worth right now, right? I say only, but relatively only 600 or 700 billion. So you're right in the sense that like for many of the largest players out there, it might just be like, it's not big enough yet for me to really feel like if I can only buy $10 billion of this thing, it's like, do I really want to buy like whatever 70 bips of the market or something like that? But yeah, I think that'll evolve over time. And then also I think it'll evolve as like they go down the further down the risk curve of like assets to trade and look at, like in terms of smaller market cap. And, maybe it's possible that like some of these firms like go into like Ethereum first instead of Bitcoin. And then they have like a more relative value, smaller, they could take it from more of like a venture type of bet rather than like I need to throw my whole fund into a call overwriting strat. And I think that's like the sort of difference where they're going to like view it as like more of like a slice of allocation that could become a large slice, and they'll probably sell it down if it does. Right. So they're going to be more of like that might actually, when you think about what that could cause from a fund flow perspective, could that cause ranges to appear more often? In theory, yes, right.
And you mentioned all the different the wide range of assets that are available now. At the same time, when you speak to people in the crypto space, you kind of see different tribes forming. Like there's the hardcore Bitcoin ideologues, then there's the proof of staker guys, Ethereum type guys, Cardano. So some of these are the ones that you've mentioned as well. I mean, do you have a view on like the purity of the protocols and those sorts of things, or do you kind of just you're almost kind of neutral to all of that, and you just look at each on their own terms?
Yeah, I would definitely bucket myself in more of the latter, like where it's like I like to just stay like super open-minded about this stuff in terms of like what's existed, the historical significance of what's existed, but also like how fast narratives can change. And like at the core of it, like you have like a sort of Bitcoin created like a ledger, like a kind of like a concept that works really, really well. And I think it opened up this whole like proliferation of computer scientists taking that and going in all different directions with it. And to like, I think to like shun all those directions that are occurring because one started here, and or like picking any node along those decisions and being like, this is the one that's the best and there can't be any iteration. Like I think it's just like it's intellectually dishonest to do that to yourself. So the way I like to approach the market is just to stay as open-minded as possible and keep on the pulse of as many things as possible, and just know that at the backdrop tailwind is like you have this like Pandora's box that's opened up of this whole new like way of transferring value and programming value and into sort of ways that peer-to-peer transactions can occur, and how it evolves over time. It's going to be really difficult to know or predict, and you can have views and whatnot, but also like stay open-minded and stay curious. But I do think like if you have views and you make the concentrated bets, like that's going to be the stuff that pays off the most, like in terms of like how to think about it from an investing angle. So it's not like you can't just be like, oh, I have no idea what's going on. Like you have to take some sort of probabilistic stance from an investor perspective, and how you evolve that, like how quickly you are to adjust it versus how stringent you are in it. It does matter because like when things are down, it's a lot easier to hold and pile into and be comfortable taking drawdowns in core thoughts and ideas. And I think like that's what makes like sort of holding and the tribal narratives powerful, because like these are the sort of flows in the market that are going to like double down in the down moves and not capitulate and switch around. So it is important to have those types of views in the market at the same time it is to be open-minded. So,
and a lot of our audience, are heavily involved in the conventional financial markets, and they're intrigued by the crypto space. So if they were interested in starting to add crypto to their portfolios in some way or start to trade it, I mean, what advice would you give them? So, so assume the person is very literate in financial markets, they like trading markets and so on. So the finance side they're all familiar with, but it's just that they're a bit scared of entering the crypto space, but they know they should. What types of things would you say they need to look out for, or how should they think about entering the space?
Yeah, exactly. And I'm going to avoid kind of giving advice or recommendations on this for a variety of reasons there. But I can speak to it more in terms of like, maybe like more like personally or just like from an angle of, kind of how I like to think about approaching, allocating into the space and shifting around thoughts and whatnot. Really, I think one thing I feel that is like a fallacy in many ways is like people tend to like really want to understand every single aspect of something before putting money into it, or before like kind of thinking about allocating into it or whatnot. Where I've sometimes actually found the opposite is somewhat true, where it's like once you're involved, then you're going to sort of understand it. It's almost like, betting on a sports game, right? It's like when the game starts, you know nothing about the team. And then you might place a bet, and then all of a sudden you're like Googling like all the players that are on the team, and like kind of you're like, oh, this guy's really good. This guy's actually
okay. Yeah. That's a good point. Yeah.
So it's kind of like that, where it's like, don't be, where it's like the trepidation could be like, and it's, obviously do research and do things before you do it, but also like it's a very sort of, two-step thing there, a two-sided equation there, where it's like on one hand, you might actually end up learning more after you're involved there. So there's that component of it where it's like, don't feel like you have to research like there's so much information out there. And if you're going to be like, I need to understand all of this, then dive in, the timing and everything is just not going to work out. It's like too much. So that's, I think, the number one, if most important thing there, right? Where it's like, be comfortable with taking risk and learning after the fact a little bit. And then, but in terms of like actual resources, like Yeah, I would just stay clear of like there's like a lot of like programmers and like interesting people in the space that put out like good like content on like YouTube or like Medium and Twitter and whatnot. Twitter is like a huge component, like crypto Twitter or whatever, where you can follow some specific profiles or create lists that do a lot of these interesting things. And you're going to just get better headlines and or just better information than if you were to just like have like a Google alert set for like Ethereum or Bitcoin and click the top links, right? Because like by the time those links are talking about something or even like the way that they're going to aggregate that information, it's like they're pulling it from other sources that have talked about it before in a better way, most likely. And there are some good publications out there that are more crypto native that are actually, I think, probably better equipped if you're going to go down like the more sort of like reporting route. Like there's just a lot of like solid sort of works out there. And like I can share with you, kind of maybe after this, like kind of the names or things like that in terms of which ones.
But certainly Twitter's an important platform to kind of get the fresh information and insights, you'd say, yeah.
Yeah, Twitter is really powerful. Because, and there's a lot of like engagement in terms of like things that get liked a lot or retweeted. And you could kind of stay on top of like, the sort of what's being talked about, what's at the forefront of people's minds. There's good YouTube content from like developers in the space that I think are pretty good, like in terms specifically like Ethereum developers or Bitcoin developers, whatever. Like, they'll talk about all the upgrades and like they'll like go through like the GitHub sort of comments for the week and like talk about what people are talking about and synthesize it in a good way. So you can get as really deep and technical if you want. And they'll talk about upgrades and sort of like, specific protocols, upgrades that are on chain. Cause like, there's like interesting ways to talk about it there. Then that's more like on the smart contract angle. Like in terms of like the macro angle, like, there's like, I think there's some good like work out there from like the more like the macro thinkers out there that have done like, why Bitcoin can make sense. Even our sister company, like Grayscale, has some research on that in terms of like portfolio allocation theory, in terms of how you view it in a broader portfolio. So like all that I think helps.
And what about the mechanics? Because I mean, something that I think people are concerned about is they hear things like the cold wallet exchanges and all of that side. I mean, what's your advice on that side? Just the not the practical side of it.
Yes, I think with the cold wallets and the exchanges, I think what crypto is broadly going to do in terms of the long term, in terms of how people think about asset allocation and where they're holding things, it's going to bring to light like counterparty risk and where things are custodied and what's bearer and what's not to a whole new light in terms of people's mindsets. Like for years, like, everything was kind of on like various little apps on your phone, or even before that, like websites, like, your bank, your brokerage and whatnot. But you don't really know, like kind of like your stock certificates and all those things, like they're just on like these servers and whatnot. And I think that's good. Like in some ways, like you're going to want things that are of that nature. And then you're also maybe going to want things that are bearer in the future. But like, it depends on who you are as an institution or who you are as a person. Like, let's say you're talking about it from an individual perspective, which is like, let's say the most free perspective in terms of where you can hold things and whatnot. Like, I do think there's a future where individuals are going to have to evaluate, like, how much do I want bearer that's in my control? How much do I want bearer that's in my control? And three of the 5 of the best friends I have to also confirm it. And then how much do I want with the bank? How much do I want with my brokerage and whatever? And you think about kind of how you want to move those ratios accordingly. It also depends on where you are in life, what you're doing, whether you're traveling or not. And there's all sorts of interesting ways and then like wills and whatnot. But for like the institutional angle, I think removing that bearer component is super important. And there are more and more sophisticated ways to remove it in a way where even if the company that is custodying what you're holding like goes away or like dies, like you could still extract your value out of it. It's basically this technology called MPC, multi-party computation. It's like a kind of shards which like effectively means like breaks up the secret so that it can be unlocked with multiple parties where that company doesn't have to be one of them. That's the way you're going to want to deal with this in terms of from an institutional perspective. And there's also like custodians that are much more like, not on that purpose, where they actually have it physically cold storage stored. And there's like, armed security guards, and it's like in some bunker in Switzerland. And that's like another way to think about it too. And that's how you think about maybe storing like physical assets like gold. So it's like bearer, you keep the one key aspect of it, but you put it in a highly secure location. So there's all different ways to do it. And I think my answer might have just made people more daunted to store it. But I would say if I had to pick of all of those, the ones that's like, the one that that definitely look into, I would say look into MPC, multi-party computation.
Okay, great. Okay, no, that was all great. Now, I did want to kind of wrap up our conversation with some personal questions. I always like to ask my guests these. One is, what's the best investment advice you've ever been given?
So I think that one is, I would say there's a couple close ones here, but if I had to pick one that's the best, it's don't be afraid of losing money.
Okay.
Some of the best investments you make, you gut into them, and then they work out, and then you get super into it, and then it just causes a cascade of other investments that could work out. So, don't be afraid of losing money.
And the other question I had was, especially in your space, I guess, there's just overwhelming amounts of information and developments. I mean, do you have a system or something to keep on top of everything? I mean, how do you stay on top of all of these sorts of things?
Oh, yeah. It's wild. Yeah. And even for me too, at my core of my job is I'm a sell side trader too, right? So it's I have all these chats and all these things flowing in, emails, calls and whatnot. So there's a lot of inbound going on. I think organizing inflow from just a chat perspective for me, into folders and things like that is important. That might be less relevant to the average person reading this. So I'll focus more on the information that I choose to look at. But yeah, for me, it's more of a routine that I've developed from the moment I wake up to when I first decide to check certain things. If I go on a whim and just kind of check all these things randomly, I'm going to be ping ponging between too many things. So the first thing I wake up and I check is I check the forward curve every morning. I check the spot, the swaps, the futures, right? I check what those annualized rates are. And I use my own sort of trading view sort of tables, as well as skew and other things to kind of, or Genesis volatility, which is another site to deal with that. So I have those short list of things that I hit first, right? Then it's whatever, you go through a bunch of chats and emails, get that to zero. Then try to read a couple headlines, scroll through Twitter for a little bit, at least for a few minutes, get what are people talking about, go through some of the research reports I get, or the emails that I the emails that are a few things to start your day. It's a couple bullet points. So go through that. And then end of day, I try to do the same things that I did in the beginning of the day, look at the curves again, look at the funding rates, look at the more just quantitative aspects of things. And then, try to get a couple more scrolls through Twitter in, and also a couple more sort of headlines in. And then kind of, sometimes you get an interesting, an author, just put out a piece that you have to sort of read. And oftentimes I'll just kind of create a backlog of things to read like that. But if one of those came out, especially ones that come from prominent sort of people that only write things ever so often, I'll try to read it the same day. Because the earlier you read it to the time it came out, the more you can be involved in the post discussion. So there's a sort of deteriorating effect of saving it for later and then trying to talk about it with everyone, because everyone read it day one. So try to read the most important things day of. And yeah, that's kind of it, really.
Okay, no, that's great. That's really useful, actually. And actually, something that does come out speaking to you is that there is a sort of very two-way active community in the crypto space, more so than in other spaces, where people publish something, then people talk about it, they share stuff. There's a lot more of that, it seems, than in the more conventional finance space where...
Definitely. It's so wild. Someone will create a protocol and launch something, and you can go read into it and look at the white paper and maybe have a question. You pop into their Discord and the founder responds to you within 2 minutes. You could just kind of, and don't be afraid of using Discord and Telegram to ask questions. Teams will literally respond to you instantly. It's pretty awesome.
Yeah, no, that's great. And now the final question is about books. I love reading. Are there any books that have really influenced you, either in the work context or even personally?
Yeah, so I mean, a few books, and yeah, as of late too, I've been getting so much more information from just articles and Medium and posts and whatnot, where it's you got to balance out the reading. And I think definitely have to pick some more modern ones, but I think ones that historically that I've really liked, that have definitely shaped my way of thinking. One is The Beginning of Infinity by David Deutsch. I think I'm pronouncing his last name right.
Yeah, it's a really good one. Yeah,
it's an interesting one. And you don't have to read all of it. I also skip around too, in terms of books. I think there's a chapter in there about mimetics that's really interesting. Same thing in The Selfish Gene by Richard Dawkins. There's also a chapter on mimetics that I think both of those kind of go along with each other. Some of the more maybe cliche ones at this point, but did definitely help out, was Sapiens, obviously by Yuval, and then also The Sovereign Individual, which was great. Some random books on markets, just generally, if you wanted to read. I wrote my senior thesis on oil and futures, which was really random, but a huge help in that one was this author named Diego Parrila, that he has a book about the energy world is flat, which is just a really interesting read about shale and fracking and the evolution of oil and kind of the history of oil. which is really interesting.
I actually worked with Diego in my early days at JP Morgan.
Oh, really? That's awesome. Yeah, he's like somewhat of an idol of mine, like in terms of that, because I like his book was like 80% of my source value for my thesis. Yeah. And then in terms of like maybe like fiction, I do like the Three Body Trilogy a lot. By Kixon. Yeah, really good. That's probably my favorite fiction book as of late that I read probably in the past 5 or 6 years. Yeah, just really good. Great read. Just keeps blowing itself out of proportion. So that one I like a lot. But yeah, I gave a lot there, so I'll stop.
That's a great selection. Yeah, you definitely have a bit of thread of science that runs through your selections there.
Yeah, that's true.
Okay, no, that's all great. And if people wanted to follow you more closely, I mean, what's the best way for people to follow your thinking or what you're up to?
Yeah, so I mean, Twitter is definitely a good one because it's like I use it basically as like a public journal of sorts, like a tame one that I can be okay with like everything on there as public and like I have a job. But more so like if you wanted to talk, and then if you wanted to like DM me there, like I could give you my Telegram or email and maybe set up a call or at least be able to chat more, like back and forth. Like I'm more of a chat person than like a call person generally, just given kind of being able to choose when to do things. So Twitter DMs is also very good. They're open. And then I could always translate it to Telegram if it starts getting more involved there. So yeah, I would say that it's pretty good.
Well, on that note, we can sort of wrap up the conversation. That was really, really good. So just a big sort of thank you for, taking the time to sort of share your insights.
Oh, no, thank you. Yeah, it was a pleasure to be here. Thank you for having me. And yeah, we'll stay in touch.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment. Let other people know about the show. We'd be really grateful. Also, sign up to become a member of MacroHive at macrohive.com. We'll be back soon, so tune in then.